are going to do something that we've never done before, which is a live interview. So who knows where this is going to go. It's Tim Oden and Mason Braswell. So they're going to be up here. We have to get them mic'd up and everything else. Tim has a really beautiful office in a beautiful part of California that I urge everyone to go visit him. And he's never there. That's true. So I don't have, again, my staff failed to provide me with the bullet points for everybody, but it's easy to introduce Tim. Whenever I talk to any of the very, very high quality field folks at Schwab, and they do have some very good field folks if you're ever looking into this and you want to talk to them, really high quality guys, they always say, oh yeah, Tim is my boss's boss. So that's what he does. He's the boss's boss of all the field guys. And as a practical matter, you know, that's what we want to do. The Ameriprise folks were field-oriented folks, able to take questions, and I think we all know Mason is probably one of the two best reporters in our industry. So without further ado, let's have him come up and do this live interview format. Mason and Tim.
You want to just yell?
Well, you can yell. Oh, we are waiting for microphone. Waiting for these technical things. These don't ever tell me that, because I actually will. And also, you know, we do have the format this afternoon is Dave Gann, the protocol attorney. He's going to be able to take some Q&A from you. The panels and the transition panels are all Q&A, so they all work much better when you guys are out there actually talking and asking questions. So again, here they are. They're ready. Thank you very much, and thank you guys. Appreciate everyone being here once again. Thanks.
Wow. So are we supposed to stare at each other? That's kind of awkward. Yeah, okay. Just eye contact? Okay, great. Boss is boss. What a crappy way to be described. Overhead. Wow, good to see everybody. Thanks for giving me an opportunity to be able to spend some time with you. As Tony was mentioning, my name's Tim Oden. I've been responsible for business development and advisor services for Schwab Institutional for about 32 years. Servicing investment advisors for that entire time. So it's been a long time that I've been in this industry. When I was talking with Tony and his team about this conference and the opportunity to be able to hopefully spend some time talking about the trends, the analysis of what we see in terms of the independent space, answer some questions. We've got some points we want to make, but hopefully we'll get to Q&A with all of you and answer any questions that you may have in the audience. I think that's a better use of our time. So is that all right with you, Mason?
Absolutely. Thanks so much for joining us.
Yeah, you bet.
So given that background, what can you give some historical context? What did the RIA space look like when you were shifting over to the institutional side at Schwab in 1990?
Yeah, that's a great question. So we started the predecessor to the Advisor Services Unit in April of 1987. And 1990 is when I was working with them full time. Before that, a couple of years, again, it was a little bit more opaque how you were servicing advisors. 1990 is when I started working directly with supporting advisors, first on the operations side, then running the trading desk, and then ultimately moving into regional support and then business development. At the time, we thought it was really cool. Collectively, we custodied and serviced $1.2 billion of assets on behalf of registered investment advisors. Yeah, I hear the snickering. If I don't bring in $1.2 billion of new assets every 3 weeks, my job is highly in question. So when you think about growth, it has gone up significantly. So then we were very much a niche player. Nobody understood what independence meant. Nobody understood what the ramifications are and what the value was to a potential advisor making that shift. And bluntly, the ecosystem that was in existence at the time was pretty basic, pretty rudimentary. And at the time, anybody who was thinking about independence looked at the custodian as being the sole proprietary provider of all the services, the technology, the services, support, practice management, all of that. And so it was really incumbent upon us to be able to be all things to all people. And that's changed. That's dramatically different than obviously the ecosystem now.
And obviously the 1.2 billion, you're at like 1.7 trillion or something like that today?
I don't know, I haven't looked at the market today. It was 1.7 yesterday when we opened. So 1.3 today maybe?
Right. Are we at a saturation point in the industry? Given it seems like every other day we're writing about people going independent, and the numbers seem to be an escalating trend. Where do you grow from here?
Yeah, it's a good question. So I get that question a lot, actually. And I take exception to the word trend. Tell me about the independent trend. It's not a trend when year after year after year after year, the same statistics apply. If it was, a year or two, yeah, okay, we'll call that a trend. But every year we have the same question, and every year I say the same thing. It's a fundamental shift in the way wealth management is being managed, both by the consumers, the owners of the wealth, as well as the advisors that service them. Just a fundamental shift. And so is there anything, you asked the question, have we gotten saturated? Well, not from anything we can tell. And, as somebody whose goals are set based on the expectations for future growth, I'd love to be able to position with our board of directors that we, in fact, are saturated. It would be a little self-interested, but the reality is, if you think about growth, so one of the metrics we follow is SEC registrations. As you know, many of you know, if you're going to have over $100 million in assets under management, you register with the SEC. So we track SEC as well as state, but SEC is easier because it's centralized registrations. 2013, we had about 150 independent registrations with the SEC, over $100 million in assets under management. 2017, that number was 258. And so it's about a 59% increase in just those 4 years. And what's interesting is not just the numbers are going up, which is a year-over-year growth, right? It's not just going up, spiking. It's a consistent increase over that time frame. But what's not in that number is the average size of the book of business for the advisors that are making those shifts. And so we have more people entering the independent space, and the size of the books of business are going up as well. Larger, more complex books of business that are entering into that space. And so that yields the asset movement that we've been enjoying. Last year, new client acquisition was about $34 billion of net new assets. Net new assets into the advisor services business, which includes not only the addition of new clients, which is what I'm responsible for, but the growth with our existing clients, which is predominantly coming from banks, wirehouses, independent broker-dealers. That's where they're growing their business from what we can tell. About $109 billion last year. So again, it's a very formidable growth business.
What are the common characteristics you're seeing among the people who are shifting over? And if I'm at a wirehouse and thinking about this, how do people know if it's a right fit for them? Do you need 50 million in assets at least? Are there quantitative numbers or qualitative things?
Yeah, it's interesting. It's not. A lot of people think, well, I've got to have a certain book size or certain production size, and it really isn't the case. The platform for independence can support emerging advisors, somebody that's just starting off, as well as it can support the 20, 30, 40 billion dollar advisors that we do business with. And so it's very robust from that standpoint. So it isn't necessarily an asset hurdle. It's more of a philosophical metric. And that is that do you see yourself as an entrepreneur? Because if you are, then running a business or being part of an independent business is important. And this is a great way to be able to exercise that muscle. The other thing is that how do you manage your business? And what's interesting to us, you think about the conversation about fiduciary versus suitability standards and how how that argument has persisted in this industry. We find a lot of really great qualified advisors within all of those segments we mentioned that are already acting like independents. They're just doing so in an environment that isn't necessarily supportive of the independent model or as supportive of the independent model. And so they eventually tell us that they outgrow that channel. And so they're looking for something that can accelerate their growth because they see themselves as independent. They're just operating in the wrong channel. So that's where a lot of our growth comes from. People are moving from one channel to the next and taking advantage of the resources that we bring to bear to help independents grow.
Right. On the other side of that, I imagine all tens of thousands of wirehouse brokers are on your prospecting list, but who's it not for?
Oh, that's a great question. It's probably not for more than it is for, if that makes sense. If you are the type of person that you're not entrepreneurial, you're not looking at hanging out a shingle or having some ability to control your own branding or how you're servicing your clients. If you like that kind of structure that comes with large broker-dealer, then independence probably isn't right for you because you're going to be faced with a lot of decisions, right? The decisions themselves are both the enabler and the hurdle. If you don't like making decisions, independence is going to be a challenge for you because you're going to have unbelievable amounts of flexibility how you craft your business to service your clients. Well, that means you have to make decisions. And those decisions fall on you. You don't outsource that to the manager. You don't outsource that to somebody else. That's your decision making. So I think for those folks that are looking to be able to just come in, focus on the clients, not have to worry about managing a business, like the idea of a large industrial brand on their business card, then those are folks that are best in the other models. It's just not the right change for them.
In terms of hang-ups, the obvious one, I guess we're coming up on the 1-year anniversary almost of the Brexit event. Did that slow things down? Did that cause people to rethink their decision to go independent? Or?
Yeah. You speak of the protocol. It's
Right.
interesting. It did not change anybody's point of view about leaving. It did increase, in some cases, the timeliness. So many of them, as you can imagine, as soon as it was announced certain firms were leaving the protocol, we got immediately, all those that were thinking about leaving in the first quarter left within the next 2 weeks. So that was a challenge, but it was just a change in timing.
Right.
Then there was a period of about 3 months where everybody was waiting for the dust to settle. What's this look like? And what are the hurdles going to be? How are those employers going to respond to advisors that are still leaving? And then does it change the choreography when I decide to make my move? And I think that became the big issue is I want to see if the rules have changed so that I can adjust how I leave, not if I will leave. This is slight editorial, but I'm not sure making it harder for people to have free choice ever really gets a good response. And that's how a lot of the advisors that moved over responded to us, is that it doesn't feel good to me that my current employer is making it harder for me to make a good choice. They're investing more in preventing me from leaving than incenting me to stay. And so that was a very commonality. And so what we saw was the first quarter was a little bit of a slowdown time frame. And so second quarter then went back to makeup. And so we're back on pace to being another record year. We've had 6 straight record years. And so it just keeps building on it. This year's looking to be another one of those.
That's by assets or number of advisors moving?
Both.
Sure.
So I'm part of one of the executive protocol conferences. I hear what they say the reason was, but do you have any color as to why they would do this? I mean, the optics of this, to me, are horrible. And I feel like in the twilight zone sometimes. I talk to people and I said, what do you think about using this protocol? And he's like, shrug your shoulders, they move on.
Yeah.
I think the optics are terrible.
Yeah.
I cannot understand what they had to gain other than a defensive move because some big guys left.
Yeah, it's a good question.
That's what they said in their release, right? It was, smaller firms were gaming the system, I think. But
Yeah, gaming. Well, what's gaming the system? So if anybody can define gaming the system, I think when the original signatories on the protocol, there was only a couple, and they were trying to reduce the cost of the litigation associated with suing each other back and forth for advisor movement. And so they came up with some standards around that allowed them to be able to move without fear of litigation. Right? That was the idea. Well, in that, if you've ever read the rules, there was nothing that said that other people couldn't sign up for the protocol. And so those of us in the independent space immediately recognize, well, great, if the protocol provides you with protections, certain protections, and it gives you guardrails around what a professional transition looks like, then why wouldn't everybody want to use that standard? And so advisors that were coming out and starting independent firms signed up to be members of the protocol. And they therefore were granted protections that the rest of the firms had. And so I think, I've never heard them comment to explain it, but I think when they say they were gaming the system, I think that's what they're insinuating is that smaller firms were able to sign up for the protocol and in doing so, have a really clear set of rules around how a transition should occur, and then they would avoid the litigation risks associated with that transition. I think they called that gaming. I call that just fair, free choice of movement.
just curious, do you ever see anybody going the other direction, RIA back to wirehouse?
No.
Okay.
No, there was, a couple years ago, there was a junior advisor at one of the RIA firms who wanted to break away and actually was enticed to go back to an independent broker-dealer from an existing RIA. The RIA firm didn't move, one of the brokers did. I'm sure there's movement amongst firms, right, professionals, but in terms of people saying, you know what, I'm just tired of being independent, I want to go back to that other environment, it doesn't work. And it gets harder and harder for them to make that transition because they've made choices around how they service their clients, choices around technology and branding and the types of service and products they use that don't fit into the other model. And so going back would be just painful.
Yeah. Now that you've seen a few people make the move and cross that line sort of successfully from wirehouse to RIA without getting sued, do you have advice for people?
Yeah. Well, selfishly, do it soon. Do it soon. We actually survey our advisors that have made the transition. We call it the sophomore survey. We just recently published some of the results. And it's interesting to hear from people after they've made the transition, but before they've reached year 2 in their life as an RIA, tell us about the experience. Everybody says, I hate transitioning, right? Nobody likes the process, but the process is getting easier and easier. What they say is that I wish I would have done it earlier. And for all the right reasons, right? A lot of people think going independent is an economic discussion. Sure, there's economic implications, but that rarely is driving somebody's decision to move to the independent channel. We know a qualified candidate when they start off with this is that I'm not able to serve my clients the way they are asking me to serve them. So either I have to change my business model or they will change advisors. And so they're looking for that choice that better serves their advisors. And so to me, that's a great starting point. Mm-hmm. So now, how do we help them make the transition? So first and foremost, it's about planning. More and more people are educated. When we first started this business, when I showed up to somebody's office to talk to them about independence, the first thing they had to say is, so independence like an independent broker-dealer? And they're like, well, no, there's a hybrid version of this, but we had to spend all of our time educating them on the spectrum of how you can actually manage people's wealth. We don't have to do that now. We show up and that self-education is already in the marketplace. People can go shop, they can educate. There's enough white papers from all the industry participants to understand what the basics are. So now when we get engaged, they're very thoughtful questions. They're very specific to capabilities. They're very specific to this is what I want to do for my clients. Can you solve this, yes or no? What does it look like? What's it cost? How do I implement? So where we spend a great deal of our time is understanding what is it you want your practice to look like. Describe it in full detail. What do you want your experience to be? What do you want to spend your time doing? What do you want your staff to be spending their time doing? How much staff do you want to have? What type of technological experience do you want to have for yourself? And most importantly, that your clients are expecting from you. Do your clients expect to call you every time they've got a question? Or do they want to be able to get online? Do they want to hear from you through a phone call? Or do they want to see you tweet something out that might be of interest to them? So we get at the heart of what they want that model to look like. That then creates a plan. And we come up with a very comprehensive plan. As a custodian, that's one of the services that custodians provide, is we help map that plan out. And then we bring resources to bear to actually help execute that plan. Think of them as transition project managers that will help walk through you and any staff that you've got how to make that transition. So planning is absolutely critical. You need to make sure that you understand and are clear with your clients once you've resigned the why you've made this change. If it's, I can make more money, you're in trouble. No client wants to hear that, right? So that's obvious. So why did you make this change? What is it that they're going to experience that is different than what they were experiencing before? If you can explain that and articulate that, then client retention is in the 90th percentile. So you tend to retain the vast majority of your clients. One of the things that we do is we listen to them. And so it's like prepping for an interview. We'll sit around a table and we'll say, okay, I'm your client, tell me why this is a good thing for me. Remembering that you've had 9 months, a year, whatever the time frame is to evaluate independence for you, they're hearing about it the first time and immediately you're asking them to make a decision. Not fair, not fair. So you've got to give them the story, and then step away and allow them to digest, and then trust that you have established the type of relationship that will bring them back to the table, start doing business with you. So I think that's part of the process. So the planning is big. setting your expectations around what that client experience is going to look like. Set yourself up for the next 3 or 4 months is going to be answering a lot of what do I do here questions for you and your staff. Because your staff often aren't going to know about this until the moment you resign. Non-compete, non-solicits prevent you from going to them ahead of time and saying, hey, I'm leaving, you want to go with me? I don't recommend that. After you've resigned, if they reach out to you, then that's when you want to be able to say, this is what I'm doing. If they initiate that, then you're in a better place. So,
I imagine the other big part of planning is how do I pay for all this? How important is financing? And then, what role did the custodians play in that?
Yeah, so I'll give you the Schwab version. We don't pay people to transition. We don't. There are plenty of firms that will support you, either through buying a percentage of your revenues or simply making short-term loans. We will make a short-term loan, but it's 100% repayable. It is not forgivable. But that loan and any support that a custodian provides is to support the transitionary expenses. You're going to have a lot of upfront expenses, so we want to be able to offset that while you're getting clients transitioned prior to billing. And so we will help firms with that, but it's not a here's a bunch of free money, we're buying your business. It just doesn't, the economics of being a custodian don't warrant that type of thing. Depending on what you're trying to do, it may not require a great deal of capital.
You can self-finance in a lot of cases.
You can self-finance, yeah. I don't know if that answers the question, but there's if you're looking to get a larger loan, there are an enormous number of firms out there that will provide you with capital to invest in the startup of an RIA.
Yeah. Do you think, you mentioned kind of as a point of distinction, you don't pay those big forgivable loans.
Yeah.
Do you think those are good for clients?
If it prevents you as an advisor from choosing a model, products and services, or technology that meet your client need, then I'm not in favor of it. I think it actually doesn't benefit clients. You can ask, the question is whether or not those payments prevent you from being able to do that effectively.
Right.
For many, the answer is no, it doesn't prevent them from doing that. But it certainly has a limitation. I mean, you're locked in. So if your current provider that's giving you a 7, 8, or worse 9-year, repayable note, if they change their technology, or worse, stop investing in their technology, and your technology is no longer best in class, and that has a negative impact to the way you manage your business or the way you interact with your clients, if you don't have a choice, then yeah, it has a negative impact. Mm-hmm. How you overcome that is where the creativity comes in, but there's a reason why they're writing those big checks.
Right. I think it was the DOL that ended up calling them out or trying to prohibit some of the back-end bonuses.
Yeah.
And speaking of the DOL, that's gone now, but how does that affect your business? Did you get some momentum from that? Does that continue with all the publicity around fiduciary?
Yeah, as I mentioned before, there's so many advisors that are managing their client interactions, looking at what's best for their client first. And that's regardless of whose name's on the business card. Mm-hmm. And so for those people, this was business as usual. They weren't in a compromised position. What I thought was interesting when we were speaking with some teams that were hybrids, they had both commission and fee-based business, and they were talking about, so the story we tell our clients about how we make money is dramatically different for the same exact client. And so how do we make that sound better? I don't know how you make that sound better. I know there's a story there, but if I'm a client and you say, okay, well, on this account, I'm held to a suitability standard, and this is what that means, and on this account, I'm held to a fiduciary standard, and this is what that means, the next question the client's going to ask is, well, so you mean you can actually act in somebody else's best interest ahead of my own? And wait a second, how long have you been able to do that? And I think that's what we heard from a lot of advisors, is that created an unwanted conversation. And it was noise. Now, again, if you're doing what's best for your clients, then I think the story's there. If you've got trust built up with your clients, the story's there. I don't want to insinuate that if you were acting in both capacities, that you were somehow ripping your clients off. Not at all. But it creates an interesting discussion. I think that's what the DOL did. It educated consumers about the difference. Mm-hmm. We did a survey a couple years ago, and we asked people to, in this double-blind survey, and so it was interesting, but we asked people various questions around whether or not they understood the difference between fiduciary and suitability standards and what their representative was held accountable to and how they were making decisions. And when you ask them, is your advisor held to doing always what's in your best interest? 85% of them said yes. So you think, okay, that's great. And then you ask them questions that asked, well, explain to me, show me that you understand what best interest looks like. And about 25% of them actually could understand and explain the difference between the two standards. And so there was this huge gap, that knowledge gap, that I think the DOL's, situation let the genie out of the bottle. It educated people. It became more commonplace for us to be able to talk about what those two differences are. There's room for both, but they have to be fully transparent and disclosed, and you have to be able to explain why. Clients not knowing and you not wanting to tell them isn't an acceptable option in our opinion. So you have to be fully transparent. So I think the DOL created conversations. But for those that were already acting in what we would consider to be a fiduciary standard, I think it was just noise, and I think it helped differentiate the independent advisor. Remember, the RIA industry, by and large, is held to that fiduciary standard. And so they see that as a key point of differentiation. They market that. They talk about that being different than other advice solutions. And so I think as that came out, they were able to say, yeah, this is what we've been talking about. And this is why it's better for you. And it made their story stronger.
And anecdotally, just in terms of talking to some of the teams that are moving, it seems like there are more that are fee only, just pure RIA. Are you seeing that as a growing trend, people giving up their broker-dealer license?
Yeah, so right now, for all new clients that are coming in, roughly 51% of them come in with some form of broker-dealer affiliation when they go independent. So we call those hybrids. Over 3 years, that remediates back down to about 25%, roughly. 25 to 30%. It fluctuates a little bit, but it remediates down. And what we find is that they tend to retain their broker-dealer affiliation for a certain amount of time to be able to transition the assets, transition the way they're managing those assets, and once that's done, they are very quick to want to get out of their broker-dealer affiliation, FINRA affiliation, and so they drop their licensing and become fee-only. So we see that a great deal.
Do you help people selecting a broker-dealer, or how do you go about that? What is that process like?
Well, there's a number of broker-dealers, RIA-friendly broker-dealers out there that will allow people the opportunity to be able to operate in both spaces. And so we obviously have relationships with the majority of them. And so if somebody's looking for a referral, we'll provide them with a list of names that they can call and do this. So we don't have any preferential go here, go there kind of a solution. But what's nice about it is that it used to be about us making that connection. But right now, so much of this is public information that they can find it on their own.
Right.
And they know, everybody knows somebody that's gone independent. And so you can call them up and ask, hey, what did you do here? And that's what we see a lot of that, that type of referral system developing in the marketplace.
What are the other big picture trends that you're seeing? It looks like a lot more private equity is getting into the space. There are a lot more strategic partners, strategic acquirers, whatever you would call them, like the dynasty type firms that are helping to transition people. What are you seeing along those lines?
Well, trend-wise, you're right. So capitalize on those people that are in the space. When we think about independence, there's this broad spectrum of what defines independence. And as a custodian, we can only support directly without some other third-party affiliation. We can only support a certain sleeve of that. If somebody is looking for a financial investment, for example, like with a dynasty or another strategic acquiring firm, we work with those firms, and that's a different spot on that spectrum. And so what we're finding is as the variability in independence grows and grows, more and more people are looking for different versions of this. More people are entering into the space and saying, I've got a better solution from a strategic standpoint. This is how I'm going to attract people coming into the space because I've got a unique value proposition here. As that happens, the pie gets bigger. There's a bigger voice in the marketplace, and there's more choices for advisors that are looking to make the move to independence. That bodes well for the continued growth in the segment. So the partnerships with strategic acquiring firms, dramatically important to us. The other thing is the interesting thing for me is to see the size of the teams that are now making the transition to independence. I mean, how many billion-dollar assets under advisement teams move in a year, right? And to have 10 or 20 of those conversations going on now on a regular basis, ongoing basis, is not uncommon. And so you think, well, wow, these are large, sophisticated teams. Why are they now representing the largest growth segment for us, these large, complex teams? And I think it's directly related to the fact that the ecosystem that supports the independent model has never been more robust than it is now. The attention has gone here. The money is going here. And so more and more product and service providers are building RIA-friendly solutions. One of my favorite things is when we're pulling somebody out of a wirehouse and they say, well, I'm sure you don't have access to the managers and the technology that we have. And it's like, well, tell me who you're working with. And they tell me, they're like, oh yeah, they're one of our best partners. Wait a second, I can get everything that I had before available on the independent platform? Yeah, well, it's in these product and service providers' best interests to be able to make themselves available to people regardless of which channel you're in. So as that ecosystem has grown more sophisticated, more and more large, sophisticated teams are finding it friendly to be able to move into the independent space because they know they can have the choice of selecting best in breed in all of those categories.
Maybe that gets back a little bit to the question earlier of what drove the protocol withdrawals.
Yeah, you know,
It started to hurt.
You know, there's a answer to that very thoughtful question that would get at the heart of, I think, something that all of us in this industry, you know, and I love Tony's industry and transition comment, that gets at it. What's the role of the advisor in the client relationship? What is the role of the advisor in the client relationship? And I think anything that makes it more difficult for an advisor to service their clients or artificially restricts an advisor's ability to be able to move when they think it's in the best interest of their clients, I think that speaks to maybe what their philosophical view is around client ownership. At Schwab, what I would tell you is that our support of the RIA space is it recognizes the primacy of the role of the advisor. The advisor is our client. We work for the advisor. We custody assets that they manage, but we work for the advisor. And I think that's just a philosophical difference that might be behind, I think, that question that you had asked earlier.
If anybody else has any questions, jump in. I think we've got about 10 minutes left. Yeah, Scott.
I thought it was interesting that you mentioned that one guy that went back to the independent channel. And we all know breakaway advisors from obviously the wirehouses, the RIA channel. But a couple of years ago, I was reading this Ruling report. It was talking about a trend with breakaway RIAs.
Yeah.
Where RIA, senior advisors that are in the RIA, you go to another one because they weren't getting either any equity or enough equity. So I'm curious about what you've seen in that and also what your thoughts are on the growth of the RIA to offer equity to people affiliated with it versus the ones that don't.
No, that's a good question. So we do see that a lot. We do see advisory firms that, much like the challenges of a wirehouse or a bank or an IBD, the senior managers have a philosophy around how they're going to manage their client base. Well, if you're a junior advisor that has developed your book of business within that RIA and your clients are looking for something different, a service model that's different, you can advocate within that organization for changes to how they service those clients. But if they're not willing to do that, then you can certainly separate from that RIA. And we see that. We see that. Again, as long as it's with the client's best interest at heart, we support it. Now, we're not trying to break apart RIAs. That doesn't work for anybody's advantage unless it's actually adding value to the clients themselves. And in situations like that, it always falls into that bucket, is that you've got a junior advisor that's looking and saying, I want to service clients differently. In some cases, it is also because economically, I want to start up my own firm. I don't have access to the equity, and therefore my participation isn't where I think, it isn't representative of the value that I bring to the firm. And so we see that as well. And I think there are so many, I mentioned the spectrums of independence. There are so many firms that will allow you to be able to participate both within equity as well as in current income, that depending on where you fall in that spectrum, there's always going to be a choice. And in fact, there's probably going to be 4 or 5 choices that you can interview and select as potential next step. I think we have seen in some cases where strategic firms have made their play by promising equity participation in search of a future secondary liquidity event, that those haven't worked out as well. That depends on where you're at on the spectrum, but it's a little bit hit or miss, right? So the jury's still out as to whether or not I think that there is going to be more of that. But as the advisor community ages, what we hear more and more from our installed base is they're looking for junior advisors to step into more of that succession leadership and to be able to start buying into that equity. And so I think that's going to be the challenge. Now, what's interesting would be, we talked about financing earlier. How do you structure? How do you finance as a senior advisor, maybe an owner of a firm? How do you finance your junior partners from being to take part of that equity? I think there's a lot of financing options out there that are starting to support that.
I think we had 2 more. One in the back and then there. Start here.
Me?
Yep.
Just 2 real quick questions. How would you handle that if an RA was custodying with you and one of their junior partners or one of their advisors wanted to break away? How would you custody the assets? Would you allow them to custody the assets with Charles Schwab, or would they have to find another custodian if they were going to break away and port those clients with them? That's one question. And then the other one is, what is your take on private equity's role in the RIA and aggregating and getting an RIA as a platform to roll up other RIAs? Is that healthy for the industry, or what's your take on that?
Yeah. So the first one is that we walk a very delicate line. And that is that when an advisor approaches us about potentially separating from an existing client, first thing we ask is, have you had constructive dialogue with that firm to try and resolve potential differences, or at least make your interest or concerns aware? And to the extent that it's no, then what we do is we encourage them to go back and initiate that conversation. In the event that they have contractual limitations to non-compete, non-solicit, that type of thing, we will honor those. And so we ask people, don't put us in a situation where you're asking us to enable inappropriate behavior. And so our first and our primary objective is to push them back to the organization to try and reconcile that. Now, there are friendly separations. Once they've done that, they come back and say, okay, we'll work with you. We play Switzerland. We don't preference anyone. We simply work the paperwork angle. But we ask them to solve things. You guys saw that, right?
Yeah.
Okay, good. Thank you. Every now and then, that other voice in my head, we want them to solve it amicably. It doesn't help anybody, including the clients, if we get into some kind of big tiff around this separation. If there's a good reason for it, talk about it, and then come to some reasonable professional decision. So that's the answer to the first question. It's delicate. Second question is that, yeah, there's a lot of money on the sidelines trying to get into this space. And so you see them stepping into that in a variety of roles, i.e. roll-ups. Let me finance somebody, let me buy some talent that understands the RIA space, let me finance them, and then let me incent teams coming out of the wirehouse or IBD or insurance space and essentially buy this capacity, create a new roll-up. I'm all for it. Mostly because it just gives more choice to advisors and how they're going to service their clients and how they're going to position their book. And so more choice is good. We want there to be more choice. And so I think that's good. What makes me nervous is if it's fast money. Are they jumping in trying to monetize something they're going to leave? Because that creates disruption that none of us wants to deal with. And again, how many people have done that over the last 20 or 30 years, right? The road's paved, right? So, but there are those that have done it right. They have the long-term perspective. They're adding value, and they're giving choices. And I think those firms are the ones that are creating the model for others to be able to step in and follow.
I think we had 2 more there in the back, yeah.
Tony spoke about self-inflicted wounds. Can you touch a little bit on the fee compression that has been led by Schwab, Fidelity, Vanguard, PD? And also, you spoke about advisor culture. How do those ads, the Schwab ads, including funny ones, support that advisor culture?
It's interesting. So the first one, fee compression. We don't see a great deal of fee compression at the advisor level yet. We survey them. That's something we've been watching a great deal. Advisors are telling us that they aren't yet subject to a great deal of that fee compression. So on the top end of the ultra high net worth, you're seeing a little bit more of it, and that makes sense, right? Everybody wants that client, so there's going to be more competition on price. But advisors largely haven't, they've been able to withstand a little bit of that pressure. Now as a custodian, very different story. As a custodian, I think their race to zero is long, we're long in the tooth on that race. And I mean, listen, I look around the crowd, for those of us that were in this business in the 80s and the 90s, you write a ticket for $4.95. I mean, anybody writing home about that, ticket? I mean, that's just crazy, right? It used to be $150, now it's $5, and going down. And so I think from a custodial standpoint, we have to constantly think about how do we drive more value? And how do we do that? Well, technology provides us with an enormous amount of scale. And we can bring that scale to bear in the form of not only additional services, but also in fee compression. That ultimately benefits our retail clients, but it also benefits our institutional clients. And so I think that's a good sign, and I welcome it. And I think it's something that ultimately, while it's a problem for us as a custodian to continue to think about how do we get more scale, the fact that it gets reinvested in client value is terrific for the market. It's terrific for the space. And I think you're going to continue to see it, by the way. And that's a good thing. Sorry, you talked about the culture thing. I think your second question was the culture. So we've got this new influx. 350, let's call it 350 new advisors coming into Schwab's institutional space every year. How do we prevent that from becoming a dilutive cultural experience? It's a challenge. It's a challenge. We spend a great deal of time in the first year trying to help them understand what life is like being an independent. And it's different. So we have a lot of events. We do a lot of socialization. As soon as we put them in events, somebody's new, we hold events in the local markets. We bring all of our installed base in, and we'll do some practice management or some guidance on compliance or regulations. And we bring our new clients into that. And what they realize is that this isn't a group that sees themselves as competing with each other. They don't yet feel that. Now that on the fringes there is some advisor to advisor, independent to independent competition, but it's not yet where the deepest pool to fish is. They still see that as being the banks, the independent broker-dealers, the wirehouses. And so they come together and create a local community that is actually very collaborative. And that helps us instill this kind of cultural difference about being independent. We have a big national conference called Impact every year. And we encourage all of our clients to participate, because when you get there, you realize that collectively we are much stronger as a group. We can advocate for the space when we all sit around a room and talk about what's best for clients and what the industry needs to be thinking about. And so we work really hard to try and instill that. Sometimes it takes a little while. I had a recent conversation with somebody who was at 25 years at Merrill Lynch and struggled for the first 6 months. And so I had to fly in and have a conversation, and the conversation went something like this. I don't know what it was like there, but here you don't have to yell at people to get what you want, just ask. But there was a cultural difference. And I said, you're really going to get more of us there if you just, we're here to support you. And so it takes a little bit longer. It takes a little bit longer. Good question, though.
All right.
Tony's giving me which finger is that, Tony?
Sorry, I got to get the hook out.
Is that Tim has more billion-dollar producers than anyone. That's a factor that makes all this very interesting. Thank you, guys.
Yeah.
Sorry to interrupt twice.
No?
Great. Thank you, everyone.
Yeah,
Appreciate
thanks so
it.
much, Tim.